everyone, and welcome back to the channel. Today, we're rediving deep into a topic that's absolutely crucial for anyone serious about investing: fundamental analysis. I know, the term might sound a bit intimidating, but I promise, by the end of this video, you'll have a clear, actionable framework to analyze stocks like a pro. We're going to break down the 5 key metrics that can help you uncover the true health and potential of a company, moving beyond just the daily price swings and media hype. So, why do fundamentals matter so much? Think of it this way: when you buy a stock, you're not just buying a ticker symbol that goes up and down, you're buying a piece of a real business. Wouldn't you want to know if that business is actually making money, growing, and built to last? Of course you would. That's exactly what fundamental analysis helps you do. It's like being a detective, looking for clues in a company's financial reports to determine its intrinsic value. This is the strategy that legendary investors like Warren Buffett have used for decades to build incredible wealth. It's about investing, not just speculating. Alright, let's get into the nitty-gritty. Our first key metric is earnings per share, or EPS. This is probably one of the most famous metrics out there, and for good reason. EPS tells you how much profit a company makes for each outstanding share of its stock. You calculate it by taking the company's net profit and dividing it by the total number of shares. A higher EPS is generally better, as it indicates the company is more profitable. But what you really want to look for is a consistent history of growing EPS. A company that can steadily increase its earnings year after year is a sign of a strong, healthy business with a solid competitive advantage. When you see erratic or declining EPS, it's a red flag that warrants further investigation. Is it a temporary setback or a sign of deeper problems? That's the question you need to answer. Next up, we have the price-to-earnings ratio, or PE ratio. This one is all about valuation. It helps you understand if a stock is cheap or expensive relative to its earnings. You get the PE ratio by dividing the company's current stock price by its earnings per share. For example, if a stock is trading at $100 and its EPS is $5, the PE ratio is 20. A low PE might suggest a stock is undervalued, while a high PE might mean it's overvalued. This is a big but, context is everything. A high PE could be justified for a fast-growing tech company with huge future potential, whereas a lower PE might be typical for a stable, mature utility company. The key is to compare a company's PE ratio to its own historical average and to its competitors within the same industry. This comparative analysis gives you a much clearer picture of its valuation. Our third metric is the debt-to-equity ratio. This one is super important for assessing a company's financial risk. It measures how much debt a company is using to finance its assets compared to the amount of value represented in shareholders' equity. To calculate it, you simply divide the company's total liabilities by its shareholder equity. A high debt-to-equity ratio can be a major warning sign. It means the company is heavily reliant on borrowing, which can be risky, especially if interest rates rise or if the business hits a rough patch. On the other hand, a low ratio indicates a more conservative financial structure. Generally, you want to see a ratio below 1. But again, this can vary by industry. Capital-intensive industries like manufacturing or utilities might naturally have higher ratios than, say, a software company. Moving on to number 4, return on equity, or ROE. This is a powerful metric that measures how efficiently a company is using its shareholders' money to generate profits. You calculate it by dividing the company's net income by its total shareholder equity. Think of it as a grade on how well the management is running the business. A consistently high ROE, say above 15%, suggests that the company has a strong competitive advantage, what Warren Buffett calls a moat that allows it to fend off competitors and generate superior returns. When you see a company with a consistently high and stable ROE, you're likely looking at a top-tier business. It shows that for every dollar of equity, the company is creating significant value. Last but certainly not least, we have free cash flow, or FC. Some investors consider this the single most important metric, and I can see why. Free cash flow is the cash a company generates after covering all its operating expenses and capital. Expenditure is the money spent on maintaining and expanding its asset base. This is the real, actual cash left over that the company can use for anything it wants: paying down debt, paying dividends to shareholders, buying back its own stock, or making acquisitions. It's the lifeblood of a business. A company can manipulate its earnings on paper, but it's much harder to fake cash. Strong and growing free cash flow is an undeniable sign of a healthy, profitable, and sustainable business. It gives the company flexibility and the power to create value for its shareholders over the long term. So, let's recap the 5 pillars of our fundamental analysis. First, earnings per share to check profitability and growth. Second, the PE ratio to assess valuation. Third, the debt-to-equity ratio to gauge financial risk. Fourth, return on equity to measure management's effectiveness. And fifth, free cash flow to see the real cash the business is generating. Now, you might be wondering, where do I find all this information? It's all publicly available in a company's financial statements, which you can find in their quarterly and annual reports on their investor relations website or on financial data platforms like Yahoo Finance, Google Finance, or your brokerage's research tools. Looking at these numbers might seem daunting at first, but once you know what you're looking for, it becomes a fascinating puzzle. Remember, no single metric tells the whole story. The real power comes from using these 5 metrics together to build a comprehensive view of the company. Does it have growing earnings? Is it reasonably priced? Is its debt manageable? Is it generating great returns on its equity? And is it producing a lot of free cash? If you can answer yes to these questions, you've likely found a solid potential investment. Fundamental analysis isn't a get-rich-quick scheme. It's a disciplined, long-term approach that requires patience and a bit of homework. But the payoff is huge. It empowers you to make informed decisions, avoid speculative traps, and build a portfolio of high-quality companies that can grow your wealth steadily over time. You'll start to see the market not as a casino, but as a collection of businesses you can own and profit from. I encourage you to pick a company you're interested in and try applying this 5-metric framework. Pull up its financials and see what story the numbers tell. You might be surprised by what you discover. This is how you move from being a passive market participant to being a true, intelligent investor. That's all for today's deep dive. I hope this guide has demystified fundamental analysis and given you the confidence to start analyzing stocks on your own. If you found this video helpful, please give it a big thumbs up. And don't forget to hit that subscribe button and ring the bell so you won't miss our future content. We've got a lot more investing insights coming your way. Thanks for watching, and I'll see you in the next video.